Look at that. We are live. Good morning, everybody. Welcome to a special episode of Benzinga All Access. I'm Spencer Israel. Normally, when we do this show, we talk to CEOs, CFOs, founders of public companies about their business, right? And about the sandbox that they play in and the growth drivers and the levers and the pulleys and the vulnerabilities. Today, we're doing something a little bit different, though. We're not talking to any public companies. We're not talking about public companies at all. We're talking about real estate. And the reason we're doing this today is because we've gotten a lot of inquiries, a lot of messages, a lot of DMs, a lot of emails, a lot of chats in the past couple of months from our readers, our viewers, that are asking us this repeated question. Where can I go outside of the stock market? The stock market is not a fun place right now. The bond market is not a fun place right now. Crypto is not a fun place right now. So what can I do with and I can't hold cash. So what can I do with my money right now? So we're going to the alternatives world for a minute today. We're going to talk all about real estate. I have joining me today 5 different real estate investing companies, platforms that offer exposure to real estate in different ways, right? And this is the way I see it, the golden opportunity for platforms like the ones we're going to have on the show today. Because as I just said, it's volatile out there. We may or may not be going into a recession. There's a lot of uncertain macro forces. And when that happens, people look to other alternative assets like collectibles or real estate. So that's the theme of today's show. It is real estate. I have 5 companies on. I have five guests joining me. This is all access. So strap in, get ready to ask questions, because I'm going to give everyone the chance to ask questions of these companies when they're on. That's part of this show. We do this as much for me as it is for you. And smash that like button, and let's roll that intro. Before I bring on our first guest, just a couple of housekeeping items to get out of the way. Number one, All Access is a sponsored show in more than one ways. First off, the show has a sponsor. That recurring sponsor is Ticker, TIICKER.com. If you don't know what Ticker is, if you've never heard of Ticker, if you've never watched this show, this should explain what Ticker does in a second.
What is Ticker? That's right. Ticker with 2 I's, just like you. Because it's for you, for investing, for stock perks, for connecting you to public companies who reward you as a shareholder, as a brand lover. That's why people can't stop tickering. Ticker perks, and consumers become investors in the brands they love. Ticker. Start tickering today.
So if you go to the link on the screen, TIICKER.com/Benzinga, create an account, connect your brokerage account to your Ticker account. After 30 days, Ticker will send you a $20 Amazon gift card just because you came from Benzinga. Check it out. Second thing I want to say is, yes, this is a sponsored show in the fact that all of the guests on today's show have paid Benzinga to be here. But, and this is the but, and I always say this part, they don't know what we're going to talk about. They have some idea, but they don't know what I'm going to ask them. They don't know I don't even know what I'm going to ask them. Okay, that's the truth. I don't have questions written down in front of me. I have notes, but that's all I've got is notes. So whatever pops into my head. They also don't know what you're going to ask them. Okay, so we open the floor up to you. Ask away. Okay, everything is fair game here. That's the point. So got those announcements out of the way. It is 9:20. I think it's time for our first guest of the day, and he's here right now. Brent Hieggelke. He is, Hieggelke, that's right, is the CMO, the Chief Marketing Officer of Crowdstreet. Let's get him on right now. Brent, good morning, sir.
Hey, Spencer, how are you? Great to be here.
Great to have you. So the way I want to start this, and I'll actually start all of these segments this way today, is just briefly explain Crowdstreet and what you offer.
Sure. So Crowdstreet, it came out of the Jobs Act, which was basically a legislation change that allowed individuals to start investing in large-scale commercial real estate projects. These are typically projects that individuals only had access to if they were a country club buddy or they golfed with a local real estate developer. So these are large-scale projects, generally, in between 25 to $150 million in total project. And individuals can now go to the marketplace and look at a variety of different direct access projects where we basically connect the investor to the real estate developer, or sponsors, we call them more commonly, so that the individual can invest directly in that project. It's equity investments, and it is a way to get access to projects that you never had access to before. And that's it in a nutshell.
So let's zero in on the niche there, which is commercial real estate, and we're not talking residential, we're not talking industrial, or why commercial real estate? Why is that your niche, and what is so interesting about commercial real estate for investors?
Yeah, so let me clarify that. So commercial real estate is a broad category.
Okay.
It does actually include multifamily, student housing, senior living. So there are residential components for sure.
Okay.
And think about a multifamily development with 450 apartments, right? So these are large scale. They can be mixed use, right? You see a lot of these, new projects where you've got lots of high-end residential units above retail centers with, community centers. These kinds of projects are considered commercial real estate projects. So that there is a large component of kind of quote unquote residential. What it's not is single family homes.
Okay.
So,
right.
Single family homes, rental homes, that kind of thing. That's not what we're talking about. Commercial real estate is broad. I think we've had over 24 different project types show up on our platform. So industrial projects. So one of the things that came out of the pandemic was the rise of e-commerce. E-commerce gave a massive focus on logistics and warehousing and things that are considered industrial. So we offered lots of projects in that arena because those were really, really strong assets. Self-storage, when the economy turns south, self-storage actually becomes a great asset to kind of consider. People are in those kinds of sectors become in higher demand. So it's a broad sector. Think of it as everything, we all know what commercial real estate is, right? You drive down the street, you go to downtown, it's office buildings, it's retail centers, it's multifamily projects. It's
right.
a wide basket of things. But yeah, think of it as almost everything besides kind of the single family sector. That's kind of an easiest way to kind of think about what it is.
Let's talk about like the risk and return profile characteristics that whether it's commercial real estate at large or Crowdstreet's specific deals have.
Yeah. So one of the things that we do is, we're a marketplace, but we're not just open. You can't just go post. A real estate developer can't just go to Crowdstreet and post their project on their own. We have an investments team that actually reviews every single project. They look at every single real estate developer. Again, we call them sponsors, and they go through the business plans. They go through the track records. Our goal is to really partner with the very best, most experienced, largest firms in the country. Right? These are the firms that you would never have access to as an individual, typically. And so
such as whom?
Oh, I'm based in Chicago, so a firm called Sterling Bay. There's a firm called Greystar. They're the largest multifamily apartment manager in the country. Hundreds and hundreds of thousands of units under management. These are firms that have billions of dollars of projects under their belt. They have track records that are very enviable. Right? These are the firms that are the best and brightest in the industry. That's our goal. That's what we're trying to bring to the retail investor. So,
what sort of returns can generally be expected from the asset class, broadly speaking? I know maybe you can't get specific. I don't know.
So there's a range of projected returns. If you go to our marketplace, you're going to see the projects that are live. You're going to click on one, you'll be able to see kind of what they're expecting with their business plan for returns. But what I can tell you definitively is what we've seen already. So we've had over 100 exits. These are projects that were invested in and then sold. And across those 100 exits today, the IRR, right, the annualized return rate the investor has seen, again, this is across all the deals, has been 18.3%. Right, so that's a pretty solid return. If you go out making over 18% on your money annualized, that's what we've seen to date historically, and that's 1.49 equity multiple, right? So if you put your money in, you're getting a 1.49 equity multiple, again, on average across all the projects. So this is not, you're going to get this on every single project, but across the basket of 105 deals, that's what we've seen historically.
What are the terms or I guess the requirements, I'm not sure how else to put it, in order to invest on a Crowdstreet?
Yeah, so we work with accredited investors. So
Okay.
I don't know if our audience is familiar with that term, but these are basically, there's a series of definitions, but think of it as people that have $1 million of investable assets, right? So think of it as beside your house, take away your primary residence, you've got about $1 million of investable assets, or you earn $200,000 as an individual or $300,000 as a married couple, right? And that qualifies you, or you work in the industry, right? So those are the rough guidelines. These are the federal government's guidelines. So we work sorry, go ahead.
So no, I didn't mean to interrupt you.
Those are federal guidelines, and so within, though, if you qualify, then most of our projects start at $25,000, which might seem like a lot to somebody that's maybe just thinking about this, but again, these are projects that if you knew a developer in your local market a decade ago, $500,000 to $1 million would be the entry point, right? So $25,000 is a small fraction of what you would have paid to get access to these kinds of projects. Again, you got to keep in mind, we're talking about top tier, most experienced commercial real estate developers building, like I said, a $7,500 million project. So for them to take a $25,000 check is pretty awesome for the individual to be able to get in on at that price point.
Are there any like lockups, or what is the liquidity like of these investments?
Yeah, these are private equity investments, right? So you're basically a limited partner in the project, which means you're there for the duration until the project sells. Some of these projects, generally speaking, 3 to 7 years is probably the way to think about it. Across the 105 deals that I've mentioned, there was a 2.7-year hold period, right? So just under 3 years was kind of the average time frame. But yeah, you're not investing in something that you can turn on and trade. Now, the benefits right now, right, when we're seeing the market volatility, is that it's precisely why investors look towards commercial real estate, because it is a hedge against seeing the whipsaw actions of the markets, right? Publicly traded markets are great when they're going up, but not so great when they're going down, and not so great when you feel like you have no control over what's happening, right? So if you look back historically, public endowments, pension funds, people managing billions of dollars, family offices have historically put a significant amount of their portfolios in commercial real estate, precisely for times like these, right? Times like these when they want a hedge against what's happening in the publicly traded markets.
So you're saying that there really isn't a strong correlation, or as strong a correlation between commercial real estate and or either the overall stock market or even public real estate?
Well, like I said, they're not traded, so they're not,
Right.
subject to the cycles, right? Like,
Okay.
These are longer term holds. So, like I said, think about it as a 3 to 7 year hold period. So
Okay.
even when there's fears of a recession, right? Recessions typically are 2-year cycles. So if you're in a project for 4 or 5 years, you're not that worried about the recession. I mean, for the impact on these kinds of projects, because chances are you're going to come out of the cycle ahead of time, because these are privately owned, right? So if the market dips then there's no need to sell, right? It's like, okay, we can hold this asset, and we can wait until the market recovers and then sell it. So that's the beauty of it not being correlated to the public market, is that there's a, like I said, if you're partner for us, when we partner with the best and brightest real estate development firms, they've seen these downturns. They know how to manage through it, right? They're excellent managers of these kinds of projects.
Yeah.
They know how to sort of weather the cycle, and that's what's really important. And that's why we go out and look for the most experienced firms, is because we want folks that know what they're doing when the markets get tough.
Yeah, that lack of liquidity can almost work to protect you from yourself, right? In some ways, right? From panic selling at the bottom or whatever, because you literally can't. I'm curious what things are like right now on your end, Brent, because we know that the market has been on fuego. The real estate market, that is, has been on fuego right now. Prices actually now, at least on the residential side, I'm not sure about commercial, starting to come down a little bit, but still way up there. We know the rates are going up, so. What does all of this do to the state of the real estate market right now?
Yeah, well, it certainly has an impact in terms of what's happening. I mean, last year was sort of like the real estate market kind of off the hook, right, in terms of valuations for projects. So they were getting frothy, and so there is a cooling that's happening, which we believe, and actually our chief investment officer published a post about a month ago saying that kind of the interest rate hikes were probably warranted, given kind of the froth in the market last year, and that you want to prevent a bubble in the future, right? Nobody wants to invest in something that's a looming bubble. So we have a chief investment officer. He publishes his thoughts. We have if you go to our homepage, scroll down, you'll see a few different pieces. One about market volatility and why commercial real estate is a good hedge against that, about inflation and how to think about it, with rising interest rates. So there's some really good research there. But what we do is, because we have an investment committee, we actually are able, because we're a marketplace. This is the beauty of kind of our market. Our model is that we're not going out and buying assets and then trying to resell a piece of that. We're actually bringing deals to the marketplace, and we can pivot that marketplace makeup based on what makes sense at the given point in time. We did this in the pandemic, right? When the pandemic hit, we very quickly pivoted to the deals that made sense given what was happening at that moment, and we're doing the same thing now. Our investments team is looking at projects that make sense for today's climate, for today's volatility, so on and so forth. So you're going to see fewer deals on our marketplace. If you've been tracking Crowdstreet, you might have seen 10 to 15 individual deals on there. Today you're going to see fewer deals because we're being careful, right? We're making sure that the deals we're bringing are most likely going to be the kind of deals that make sense for today.
Speaking of that marketplace, Brent, I mean, walk me through the process at a high level of how a deal even gets there in the first place, and how you talk a little bit about how you source your deals, but can you just speak to that due diligence process for a second?
Sure. So it all starts. We have actually capital markets experts across the country. So we have people living in all the different markets. They get to know all the development firms, the sponsors in their local market. They start looking at the projects they're working on. They identify a couple projects that look to be the kind of project that would make sense for Crowdstreet. So then they take that project and they nominate.
What does that mean? Sorry, the kind of project that would make sense for Crowdstreet.
Right size. It's going to have an equity component that our market, that our investor base is going to be interested in.
Okay.
Basically something that, it's in a sector that matches our investment thesis. So we also publish an investment thesis that talks about which markets, which asset types we believe are set up for success. So if a deal they're working on, kind of looks to fit those criteria, then we'll take that to our investment committee, and then they go in and they, like I said, they review the business plan in detail. They review the market, the dynamics of the market. They look at the sponsor's track record, their historicals. And basically, then there's a vote from the investment committee. Does this deal make sense? We estimate how much money that we think our investors will commit to the project, and then we build out basically a review package. We schedule a webinar where individual investors can listen to what the sponsor's business plan is, and then it goes live on our marketplace. So that's basically the process.
Okay. What other things do investors or potential investors need to know before they invest in a deal on a marketplace like yours? Like are there other? I would imagine there are some tax implications here. I don't know. I'm asking you, like, what other things like should I know before like, other than looking at the deal itself, right, and understanding that deal and understanding things like IRR, but what other things do I need to know before I add this sort of thing to my portfolio?
Yeah, I mean, real estate has some tax advantages for sure. I'm not going to get into details because obviously it's varied by person and individual or project, but we have some projects that are opportunity zone projects, which have tremendous tax advantages for some folks. So it is wise to understand kind of what your own tax situation is and how you might benefit from real estate investing. A lot of folks are interested in the sector, but a lot of them don't have the expertise. So we actually developed a product this year called C-REIT. It's our first REIT product. It's a non-traded REIT, and we built that basically for the investor that says, I like what I'm hearing, I want to get started, but I don't really know enough to get started. So basically, this is the easy button product. This is $25,000 in, and you're going to basically get a basket of investments across the deals that are showing up in our marketplace. So they're the same projects.
Ooh.
Instead of you having to go in and review them all, we have an investment committee that manages the C-REIT that will decide which projects that the fund will invest in. So if you like what you're hearing, but you don't want to necessarily go in and start analyzing every deal, this is a great way to dip your toe in the water and start becoming familiar, get that kind of instant clarification across the basket of deals, while you then go in and start learning, what individual deals you might like.
Longtime viewers of this channel know that I'm a huge fan of ETFs, and that's exactly what that sounds like. Frankly, it sounds like an ETF, but for all the deals on your platform.
Yeah, exactly. I mean, that's a really simple way to look at it, and a great analogy.
Awesome. Brent Hieggelke is the Chief Marketing Officer at Crowdstreet. Brent, thank you so much for joining us today. I'm going to throw the URL up on the screen now. There it is, crowdstreet.com. Tell the people where they can learn more and on the site and et cetera, et cetera.
Yeah, so like I said, the homepage has, if you scroll down, you're going to see kind of all of our, economic thinking. We have our investment thesis. We have our best places to invest. So there's lots of educational materials. But if you want to start looking at the projects, go to the marketplace. That's where you're going to see the individual deals that you can invest in today.
Awesome. Brent, always a pleasure to catch up. Thanks for joining us on All Access today.
Thanks, Spencer. Great to talk to you.
All right. I'm keeping an eye on the chat, guys. If I didn't see any questions, but if I had seen questions, I would have asked them. So don't be shy. I know some of you are still digesting the news, the Spencer news bomb from half hour ago, but I'm still here. And I got a lot going on right now. We got a lot going on today and a lot going on next week. I don't want to bloviate any more than I have to. So let's actually move on to our next guest here, Alan Donenfeld. He's the CEO of CityVest. I see him lurking backstage. Let's get him on right now. Alan, welcome.
Spencer, how are you?
Good. How you doing?
Excellent. Good to see you.
Great to see you as well. Okay, I decided right when I was talking to our last guest there, I was decided I'm going to start every conversation today with the same question, which is, what the heck is CityVest? What the heck do you do?
Yeah, thanks, Spencer. Great to be here, and I hope you have a big audience. CityVest is a online investment marketplace specifically allowing accredited investors access to institutional real estate private equity funds. So the distinction between CityVest and some others, specifically CrowdStreet, who was just on, is that we only focus on institutional real estate private equity funds. We don't work with any individual deals or sponsors. They tend to be small, without track records, without audits, without administrators. So we try to have a much higher quality of transaction, investment managers rather than sponsors. In this market, you need somebody who has significant experience in number of deals, years of experience, and hopefully they've gone through cycles like the one we've been in the last couple of months.
What exactly does institutional mean in terms of size, in terms of uh, deal flow or sourcing or characteristics? Like when you say institution, who are we talking about here?
That's an astute question, because a lot of crowdfunding sites say we have institutional deals, but they're just $5 million acquisitions of properties. So what we do is we look at about 700, again I'll call it institutional real estate private equity funds. These are investment pools that are raising 50 to $300 million, and typically have about 200 million to 3 billion of acquisitions that they've already completed in the past, hundreds of millions of realized transactions. So you can actually look and see how they perform. But when I use that term institutional, it's somebody
Yeah.
who has the size. They've done literally hundreds of millions of dollars of acquisitions. This isn't their third deal as a sponsor that they're cobbling together, and they want you to focus on that property. I like to look at the track record more than the current deal, because if the investment manager that I'm working with has skin in the game, they're putting up 10% of the capital. They've got millions of dollars of their own capital invested in that project. Then there's a good chance that it's a solid project, and it's a diversified portfolio. So there's many transactions in that portfolio.
Maybe this is also a question I could have asked Brent, but I'll ask you. So maybe
Yeah.
explain the logistics of this. So and as you say, an institutional real estate investor or firm has a property or has a deal that they're going to do, and they bring the and then they invest, and then they bring the deal to you, and you put it on your platform for your investors. Did I mostly get that right?
No, sorry.
No. Okay.
So
That's why I asked.
yeah, so a an investment manager, typically a team of people that's at least 5 people. And in one of our last transactions, the company was vertically integrated and had over 400 employees. That's spread out between capital markets advisory and real estate brokerage, and they had a construction division. So a good size real estate investment company creates a limited partnership or an LLC entity, and they go out and they raise significant capital, let's say $100 million. And with that blind pool of capital, they make acquisitions that they determine are the best acquisitions. And there might be 10 to 20 different acquisitions that go in that real estate private equity fund. And to the extent that they are on their third, fourth, or fifth fund, now all of a sudden you get to see a track record, specifically if fund 1 and 2, which might have been invested in 2005 or 2010 or 2012, whenever that was that they invested that capital, you start to see a track record, realized investments, so that you can, and they're not just realized with a simple accounting, they're realized with a auditor and an administrator. So the level of your comfort that the numbers are right, that excessive fees were not taken. We want to make sure that, in the chart that you're showing, we're down in that lower right side, which is real estate funds, because we don't want to deal with a small deal, a $5 million one-off deal. We don't want to have to look after the fees of what a sponsor or crowdfunder is taking. We don't want a REIT that typically has a low distribution. We want very large real estate private equity funds who have multiple funds, multiple realized funds with auditors and administrators, so that you can trust the numbers. The problem is, as you can see on the chart, that when a fund is raising $100 million, they just don't want a $25,000, $50,000 size investor. They may have a $1 million minimum. So what CityVest does specifically is we create feeder funds, our own entity, and we will pool 100 investors together so that we're a pool of $6 million. And when we go to that institutional fund, we say, we've got $6 million that we can invest through our feeder fund, but we need enhanced investment terms. So now not only have we gained access to a fund that might have a $1 million minimum subscription, but we've also gotten better investment terms. So it's
explain what you mean by better terms.
So we sign a side letter agreement with each of these real estate funds that says you're offering an 8% preferred return followed by a percentage of profits. Typically it's 70-30 split of profits, or 75-25, 80-20, whatever that might be. And today I've seen some recent deals that preferred return or hurdle is even 7%. So we negotiate with that private equity fund and say, look, we're not going to invest your minimum of $1 million. We're going to invest $5 million or $6 million. We have a sizable chunk of money that we're going to be investing in your fund, but we want better terms. So we enter into a relatively sophisticated side letter agreement that our lawyers have worked out in detail, that specifies the change in their investment terms that are described in their limited partnership agreement and private placement memorandum. And we get a different deal than other investors get. We're going to get a 12% preferred return followed by an 80-20 split of profits, as opposed to what $1 million or $2 million investor might get, which might be only a 7 or 8% preferred return followed by 75% of profits.
Okay. This next slide is also wait a minute, make sure I'm on the right slide. This is the one I want. All right, actually, no, I want to address them both, actually. But okay, so this is basically what you just described, though.
That's exactly what I described. We have a low minimum investment in the CityVest Access Fund. It could be $25,000. Frankly, we have a lot of investors now that are in 10 of our feeder funds, and they're now up to $150,000 each. But I understand that an investor going online may not feel comfortable, and they invest 25. So we leave it as a low minimum, but we certainly have plenty of people. They've actually even gone up to $500,000 per investment. So these are the prior slide was the benefits, the access to institutional funds, the proven track records of our underlying private equity funds, the unique strategies. They might range from self-storage to distressed senior living. Our bread and butter has been multifamily. Everybody's got to live somewhere. There's been a housing shortage for years and will continue to be. So we will continue to focus on multifamily, but there always are some niche funds that a unique investment manager has expertise in their market with outsized returns. And when we're looking at 700 investment funds, we can pick and choose those that have a superlative track record of realized return. So our current fund, actually, it's called Catalyst. They have a 35% realized IRR. And when I say realized, that's properties that they bought and sold, and an auditor verifies their numbers. So that's a real number. We don't want to look at a given property and fall in love with a given property without knowing what is the historical track record of that investment fund manager. And then on this slide, yes, we're most of our funds today, given the last 10 years of real estate performance, most of our funds, if not all of our funds, have a track record that's over a 20% IRR, because that's what the market produced in the past 10 years. It's been a great period of time. The question is, what's going to happen now in the next 5 years? We're in a entirely different market than we've been in, and you need the most experienced investment sponsors, not somebody who might have made a 20% return over the past 3 years. Anybody, frankly, could have done that. Any sponsor, buy any property, cap rates came down, rents went up. It was the perfect storm to make 20% plus returns. Really, anybody could have done that. If you ever find anybody that has just a 15% return, frankly, I wouldn't invest in that fund if that was their historical performance, because it was really that easy to produce 20% plus. But once we find that great historical return, we want to make sure that that manager has all of the ingredients that that we believe we can trust them. So we have a third-party due diligence report that's written by a firm named Buttonwood, where they check on corporate governance. They're actually going to read the audit engagement agreement and the administrator's agreement to make sure that there's teeth in what those service providers are going to do for that company. So strong corporate governance. They do background checks on, whether it's liens or litigation, drunk driving arrests. They go through FINRA and SEC records. They do, social media checks. We make sure that there's a key man life insurance policy on the investment manager. And then we want to make sure that there's a certain minimum level of dollars and years of experience of each of our managers.
Alan, I was going to ask you about return profiles, but actually I want to address a comment from the chat here from Eric, who
Yes.
says, and I think he's not the only person that shares this sentiment. Basically, 2008 is about to happen again. I don't personally think that. I think people may think that because the real estate market's been on fire and prices can't stop going up.
Right.
But I want to ask you about why is this different than that?
Why is our model better, or why
Or I
real estate?
no, sorry, why is today's real estate market not that bubble from 2007?
So if I could just answer the question a little bit differently, if
Okay.
you were to invest in real estate literally today, it's difficult. There are multiple conflicting dynamics happening in the market, right? We have rising interest rates. We have rents that are going up. That's on the plus side. Rents are going up. We have the affordability index. When are rents going to hit a ceiling where people can't afford them any longer? So can rents continue to keep going up? I don't think so. So there's a number of things happening at the same time. And we know, obviously, regarding rents, that there is an excellent correlation with CPI, Consumer Price Index. Highest correlation between CPI and rents of any asset, higher than gold or stocks or anything. So for that reason alone, now is a good time because of inflation. But we also have this rising interest rate environment and the possibility of a recession. Just literally means 2 quarters of negative growth. So would I be an investor this month? It's tricky, and I would be very slow. And I was just speaking to one of my investment fund managers, and I asked him what interest rates he's able to get. He switched from his bridge borrowing, which he always got a swap and fix those rates for at least 5 years. But he switched from those rates back to agency debt, because agency debt with certain guarantees are now cheaper than what he used to get. So you need somebody experienced to know how to get that debt financing. But in today's market, when that interest rate, which by the way, in just the past week, interest rates have come off about 15 basis points. And when the Fed says we're going to have multiple 50 basis point increases, a lot of that is now baked into these expectations. And so rates coming off 15 basis points is the reflection that well, maybe they shouldn't be as high as they are. And I've started to hear in the last couple of days that inflation is starting to back up, that some of the things that had gone up in price are now dropping a little bit. So the markets will obviously come back into equilibrium. It's a question of, is that this year or next year? How long is it going to take for inflation to, the sting of inflation, to start backing up? But the problem with investing in real estate today is literally when that mortgage cost approaches 5% and your cap rates are not that far different, if they're 5.5%, how do you make a spread? I read one article last night that said that some inexperienced investors that have to pay 5.5 or 6% in interest are paying more in interest on the borrowing cost than in the cap rate, the unlevered return that they're getting from the real estate. Obviously, that doesn't make any sense. The only way you could make money is significant increases in rents. That could happen, but that's a risky way of making money in real estate. Most people talk about you make money on the buy in real estate, not on the sell. So you've got to make sure that you're buying right in today's market. It is tricky. So one reason to invest through CityVest in a fund is this pool of capital. If a manager has $100 million, they're not investing $100 million next week or even over the next 3 months. It might be a 1.5 year deployment period where they're investing that capital. And if you're an experienced investment manager with $100 million of opportunistic cash in the bank, you're not a sponsor trying to put a deal on, a crowdfunding platform to raise money over the next 3 months and hope that your deal stays there. This is opportunistic cash that you've given them for them to do the best deal that they can. They've got skin in the game, so they will do the best deal that they can. And they're going to go out and they're going to be bidding at very low prices. And if they lose on auctions, so be it, because they have opportunistic capital. They can invest over a period of time. I'm not saying today is the best time, but today is the best time to give an experienced investment fund manager your money so that they can sit there and pick off the distressed opportunities where some seller might have problems with some debt that's coming due on one side of his balance sheet, and he's got to sell another asset and he needs to sell it now. I want to invest in the fund that can buy it now at a great price so that over a 5-year period, when the markets are better, they can realize a excellent rate of return. Sorry for that long-winded answer.
No, that was a very well thought out answer, and I think if I could sum up everything that you just said in one sentence, is that you do not believe that we are in a real estate bubble, because there are people that think that, because the last time the real estate prices went up like they have it was a bubble, but this has different underlying fundamentals, it would appear.
Sure. Let's assume that this is a bubble like we were in
Okay.
2007.
Sure.
Real estate prices were crazy, and then they came down about 40% in 2008. And then what happened in 2008? So let's say that right now we're in an 2007 time period, and they come down in 2022 and maybe even into 2023. That period of time has historically not lasted very long.
If you've got the long time horizon, right, you can just add.
Absolutely. And that's the
wait it
best
out.
time. Yeah. So if you can be opportunistic and pick off assets in 2022, 2023, over the next 5-year period, if you look back to 2008 to 2013, that was an excellent period of time to be buying real estate. That's when you want to get in, whether you follow Warren Buffett, or who's been pouring money back into the stock market, by the way, or Jacob Rothschild famously said, when there's blood in the streets, that's the time to buy. Now is the time you want to give a experienced real estate investment fund manager the capital to deploy it judiciously in the great deals that he finds that other people just have to sell their assets because of their own distress in a market like this.
Alan Donenfeld is the CEO of CityVest. I put the link up on the screen. The link should also be in the description of this video. Alan, a pleasure to chat. Thanks for coming on All Access today.
Great to be here, Spencer. Thank you.
All righty. All right, let's keep this train running on time. That's one of my jobs here, is just to keep the train running on the tracks straight and also on time. I'm doing a pretty good job today, if I do say so myself. Let me interrupt just to give the call to action. If you haven't already, I really would appreciate if you hit the thumbs up button wherever you're watching this show. YouTube, LinkedIn. If you're watching on LinkedIn, hi, drop us a like there. Twitch, Twitter, we appreciate that. All right, let's bring on our third featured guest and company of the day. I've got CalTier. I've got their co-founder and CEO Matt Belcher coming on right now. Matt, good morning. Oh wait, Matt, there we are. Good morning.
I'm here. Good morning, Spencer. How are you?
Good. How are you doing today?
I'm doing very well. Doing very well.
All right. You weren't here before, so I'm going to repeat my spiel that I gave to last guest, which was I decided spontaneously as the show was starting. It probably is easier if I just start all these with the same question, which was explain your platform. So explain CalTier and what it is and how investors can participate.
Brilliant. I'd be very happy to. This was born out of frustration from the founders. I was just listening to Alan and your interview there with CityVest, and they do obviously a great job doing what they're doing. But really, that was the frustration we were having as a group, which is there's these great real estate deals and syndication deals out there, but it's for accredited investors only. And my founders and I wanted to get into these deals, and the reality is not everybody has 25, 50, 150, 250 grand every time you want to make an investment to park it for 3 to 5 years. And so you've got this huge movement now where you've got retail investors. We've seen that, right, with meme stock investing and Robinhood, and everybody wants to participate. And we're kind of a little bit tired of this glass ceiling that has been basically there for the majority of folks. So our platform allows you to invest in very similar assets, multifamily, commercial grade, institutional grade, with some amazing sponsors, but we do it kind of the other end, and we have plenty of accredited investors on our platform, but we also allow basically anyone over the age of 18 to come in with a small amount. I mean, people can come in at $500. People do. They come in at 500, they come in at 1,000. We have people that drop in 100,000 plus. And it's just, it gives what we call the retail investor, the everyday investor, the chance to participate in that type of real estate opportunity.
What's the minimum?
500.
500. All right. Nice.
Yeah.
Why did you decide to do that? Because as our other prior guests have come on today, and I mean, it's not as if this asset class is the most liquid. Or is the sexiest. I mean, these deals can take years. No, I mean, that's not an insult. These deals can take years to materialize. And why open it up to everyone with such a small minimum of $500?
Yeah, it's a great question. It is illiquid, and it is a big challenge, right, to be able to collate and build a platform and allow thousands and thousands and thousands of fractional investors to come in. How do you handle that? So like I said, this was born from frustration that my founders and I and friends and family, we wanted to participate in some of those types of investments. But like I say, there's this glass ceiling. So there are some other crowdfunding companies out there that we saw doing a great job. And we thought, this market's huge. If you look at the US household net worth, depending on where you look, it's estimated to be about 150 trillion, but only 10% of people in the United States are considered accredited. Again, that number varies depending on where you look. And that accounts estimated for about 80, so you basically have about $80 trillion that is managed by this non-accredited investor group that have basically over many, many years have been frustrated and have wanted to get in. And we see that kind of like with a trifecta effect. So, back in 2012, the Jobs Act was pushed through and then was really enacted in about 2014. And that allows companies like us, issuers like us, to offer these fractional investments. Then you've got a compliance piece,
Okay.
It's a three-legged stool, right? You've got a compliance piece, you've got a technology piece, right? So I come from a technologist background 5 years ago and a real estate background, but 5 years ago, even 5 years ago, to manage, 6, 7, 8, 100,000, 200,000 investors, gosh, you wouldn't even consider it. It would cost you a fortune. It'd be the biggest headache you could ever deal with, right? And then now you can do that. So there is software out there that's being the value and the cost of that is coming down, and it is allowing folks to, like us, to offer these to put all the pieces together and offer people the opportunity. But the biggest thing, I think, is the mindset of the community and the crowd, right? So we've seen with IPOs, you've probably been in social settings, bars, restaurants with your friends and family, and you're saying, man, look at that IPO. Like, I wish I'd got in early. I wish I'd known about it. And there's some great platforms out there.
Not the bars I go to, but okay. I
Fair enough. But there's plenty of that talk, and people are frustrated that it's kind of a closed loop. Like, why can't I get in? And so you see some great other platforms out there that are allowing like pre-IPO investments. And it's that mindset and that concept. We now do everything from our phone. And why can't you and I, Spencer, have the opportunity to make big investments like Peter Thiel did in Facebook, right? Why can't we do that? And the answer today is you can, with this trifecta effect that's coming together. We are choosing real estate. My partners and I have a background in it. We were involved in the financing side of real estate. We have a lot of access to these types of great, solid sponsors that are going out there, finding these really hard to reach multifamily assets. I mean, it's a very aggressive market because you've got so much institutional money that wants to come into it, purely because it's stable, it's cash flowing. But I did see that CBRE, maybe we'll put this in the show notes somewhere, but CBRE forecast that over the next 10 years, there's a $3 million new shortfall of multifamily. So this isn't even going in and doing the renovation and the value add. This is new stuff. So the demand is huge.
Right. And yeah, that sort of gets into why we're doing this show today, is because there are several macro factors that are driving interest in real estate as an investment. Matt, I just want to ask you about the deal flow for a second, because it just seems to me that with all of the platforms like CalTier, Realty, and others, it seems that all the secret sauce is really tied up in the sourcing of deals. Is that a fair statement?
I would say, having now lived and breathed this for last couple of years, that is absolutely one of the critical elements of it.
Okay.
Because that's the product, right? And so we can wax lyrical about, we have a great platform, the details of our offering are very attractive. I'll give you a feature benefit. For example, we don't, I would encourage anybody who's interested to read our offering circular. There is a link on our website that will take you straight to the offering circular on the SEC website. But we don't have a lock-in period, which that's really hard to do when you're managing a crowd-funded platform of people in a fairly illiquid product, right?
Yeah, I would imagine.
We do have a redemption plan.
Okay.
Okay, so, but technically we don't have a lock-in period. So when you invest with us, we don't say you're locked in for 2 years, 3 years, 5 years. If you ask to redeem your money, depending on how long you've been in, will depend on how quickly you get it back. But technically there's no lock-in. So there's features, benefits like that. But to go back to your point, the product for us is the real estate. And so if that fails, I always kind of like it to, if we were running a manufacturing business and we were manufacturing a shampoo, we can talk all day long about how smart and clever our manufacturing plant is. But if the shampoo's no good, who cares, right? And so yes, it is a critical part. It's not all of the pieces, but if that bit's not right, then everything else doesn't really matter.
So then how, like, sell us on your deal flow, then sell us on why the deal, and I'm not sure what specific areas or geographies you focus on. Actually, I am sure, but the people watching aren't sure. So can you maybe talk about that, and just sell us on that deal flow?
Sure. Yeah, I mean, we're very specific at the minute. We're going after B and C class, as they call it, multifamily value add opportunities. So for those that may not be familiar with that, the easiest way to think of it is, we're buying distressed or underperforming assets in what we consider either good or going to be good areas. So it's the same, if you read any Robert Kiyosaki books or any other book on real estate investing, it's, we're house flipping, but on a massive scale, right? So some of these units we invest into are 100, 200, 300 unit multifamily unit investments. So sometimes they need a light touch. Sometimes it's a paint job and a resurface of the tarmac. Sometimes it's a little bit more. We have to go into the units, reface the units, put in new utilities. And sometimes it's a deep renovation, which we would only do if we really considered that asset is in an area where there's economic drivers that are indicating that if we go and spend this capital, if we go in, take a year to do all these renovations, sometimes the biggest thing right now is mismanagement. A lot of, I think Alan actually said it, people have been cruising in real estate because it's just been so buoyant. And there's been a lot of mismanagement. And so we see a lot of that today, or fatigue in the team that's managing those assets. So we may go in and do a light touch. We may go in and do a deep renovation, all the HVAC, all the utilities in the units, like completely renovate, put in a dog park, dog wash. There's some great statistics right now that 8 out of 10, I think the number is 8 out of 10 multifamily units have dogs behind them, as they say. So what that really translates into is most people who have a dog, like myself, I have two. So you've got to consider the changing demographics, right? You also see a lot of things like leases now are a lot more flexible. You can give 30 days notice because people are more transient. So you've got to move with the times. Electric vehicle charging, things like that. So important. So we look at those things. We look at the micro. We look at the macro with our partners as well. We underwrite those deals with them. Often we're underwriting their underwriting, and then we will deploy money into those assets with those partners. We also do direct acquisitions ourselves. But one of the biggest things is that we're working with these very successful companies that do this. That's all they do. That's all they do all day long, is they're out there looking for deals. What that means for our investors is that we can deploy capital very quickly into those types of deals that they'd never, some of these deals are invitational only. You have to, if you're thinking of buying them, you have to have all your capital ready and have it done in 30 to 60 days,
Right. Question from our chat here. Can Matt talk about any restrictions or requirements joining the international fund?
Wow. That's a great question.
Yeah. That was not from me.
That's a great question. Domestically, our minimum is $500. Internationally, if you're coming in, it's $5,000. Pretty much everything's the same. You don't have to be accredited as per the SEC. But our minimum for international is 5,000. There's a little bit more compliance on our side. We have to do more. We have background checks, anti-money laundering, so on and so forth that happen anyway. On the international, there's a little bit more. One thing I would say to international investors, not to discourage you, but just something to consider, is when you invest into US securities, bear in mind you will have you will be under an IRS tax notification from that moment on. But yeah, for international, we do have international investors come in, and they're looking to deploy money into what they consider, and we do, a great asset class.
What types of returns should be expected on CalTier?
It's a great question. So I'm just going to make this caveat. We can't promise any returns. We're dealing with non-accredited investors. We're slightly different, right? So we have to be very soft with our wording. But
Wait,
you can
you say you tell me you can't predict the future nor promise return? What?
Right.
Is that what you just
Yeah,
said?
it's unbelievable.
All
Yeah.
right. All
Mhm.
right. Anyway.
Right. But when you're dealing with accredited investors only, you can be a bit more bullish with the wording you use. When we have a Regulation A fund, the protections out there is that folks like I can't go out and promise all these things, and people lose their money. So that's the whole point of it. But we are targeting through the fund at least an 8% return to the investors. On the asset side, for those that are familiar with the industry, you'll know these kind of numbers. We're looking at, typically we want at least a 2 to 3 times cash on cash return at the asset level. So that's slightly different than what comes back into the fund. And probably IRRs of 16+%. I was again listening to the last speaker.
Yeah.
We have had some assets that have really outperformed those numbers over the last couple of years. Is that going to happen moving forward? Don't know. Don't think so. Certainly the next couple of years. But we also feel very confident about this market we're in because there are some drivers. Baby boomers are coming out of homes. Baby boomers are moving into multifamily. They are moving around. Then you've got the younger generation that are buying homes later. The average age of having a child has gone up nearly 5-6 years, which if you think about it in the grand scheme of things, is a huge amount of time. So people are putting down roots later. And you've got this sharing economy that kind of people are thinking about. Then there's other kind of base level, fundamentals, right? So interest rates going up. People may not have cash on hand to get into their first home, and those types of things. So we see kind of some fundamental drivers, and then we see kind of some other drivers that we feel confident about the market we invest into.
Yeah, I mean, since you mentioned demographics, I mean, the oldest boomers are now entering their mid to late 70s, right? And that's around the time where a lot of people, if they haven't already, are certainly considering downsizing and going into, independent living or assisted living or something like that, or even just senior living community, right? Where
Yes.
16 up. So and then someone has to, I feel it too, because I don't own a home, so I'm in the category that is getting priced out here, but someone's gonna have to take up that inventory of homes, right? I mean, if you have all these aging homeowners, someone's got to buy that. So it certainly makes sense just from a demographics point of view. Even though there are not many new homes coming online, you have this demographic shift from the boomers to the millennials.
It's a great point.
Yeah.
I see. I'm in. I know I have this weird accent that is now a hybrid between British and a little bit American, because I've been here 11 years.
Okay.
But I'm in San Diego, and I drive. As I'm driving around, and it's interesting. Most people who have been to San Diego don't comprehend quite how big it is. Actually, if you go east a little bit, I mean, it's absolutely huge. And the product I see being built is townhomes in communities, right? And they're placing restaurants, bars, yoga studios. It's like a little compound, and we're not seeing, even in the space we have here in San Diego. Sure, there's plenty of single-family homes being built,
Right.
but what you mainly see now is this townhome concept, where it's clusters of homes, they're closer together. So for me, actually coming from Europe, coming from the UK, I'm very familiar with that, right? Because it's very typical. You go through London.
That's all you've got, right?
That's all we've got.
Right.
If you have a house that's not attached to someone else in the UK, it's like, whoa, So being next to your neighbor, having a as we call it, semi-detached or terraced, is very, very common. And I see that product coming up here a lot, and I know that they're doing a lot of that stuff in Florida too, and other parts of the country. So it's an interesting shift and dynamic that's happening.
All right, Matt Belcher is the co-founder and CEO of CalTier Realty. We'll make sure the link is in the chat, but I'll put the link up on the screen right now. It's literally
it's CalTier.fund.
CalTier.fund. Yep. Really? Oh, there it is. Yeah, I don't know why I had it on up a different thing, but there it is up on the screen right now. CalTier.fund. Matt, thank you for joining us today on All Access, and enjoy the holiday weekend.
Thank you, sir. Really appreciate it. Nice chatting with you.
All right, same here. All right, let's keep it going here. We're gonna bring on. Here's how the rest of the show was gonna go. I'll bring on my next guest, and then after him, we'll have like a 20-minute chill session. We can stop. We can look at the markets. We can get some feelings off our chest if we have that, and then we'll take it home with one last guest. But let's bring on our next guest right now. I see him here backstage. Mohsin Masud. He is the founder and the CEO of Accru, and I see him backstage. Let's get him on right now. Mohsin, how are we doing today?
Hey, good afternoon. Good. How are you doing today?
Doing fantastic. I've been opening all of these segments with the same question, so I will do the same for you. Accru, what's the deal there?
Okay, so Accru is a platform for fractional real estate investing, and I know you've heard this again and again and again and again, about 6 times so far. But we're a little bit different. We use blockchain as the underlying tech. We enable not just the initial investments, but we also have an active secondary market for the accredited investors on our platform. What that means is all those problems that everyone was talking about, how real estate's not really that liquid, we have enabled liquidity, and we've enhanced liquidity within commercial real estate. We let people not just buy in with as little as $1,000, but they can sell their share within that building, within each specific asset, as and when they choose. And we do this all within every different kind of commercial real estate asset, be it multifamily, mixed use, retail, hospitality, short-term rentals, you name it, and we've got it covered.
So if you've been paying attention today on this show, everyone watching, you've noticed a theme here where all the companies we're having on today's show, they do play in the same sandbox, but they all have different wrinkles. And in my judgment, Mohsin, the biggest wrinkle here, you dropped the B word, the blockchain word, right? So explain exactly, like, it's one thing to just say that, but like explain how you've incorporated blockchain here, because that was, blockchain is, and I probably remains one of even people who don't like crypto can say, okay, I don't like crypto, but I like the blockchain. That there are some real use cases there. This, in theory, is a great use case. So talk about how you've incorporated that onto the platform.
So this, in practice, has been a perfect use case for Accru. There's a few key things. Blockchain is not equal to crypto. Any crypto conference that I go to, any blockchain conference that I go to, or any real estate conference I go to, I always make this distinction. They're two very, very different things. Blockchain is the underlying tech that enables cryptocurrencies to function off it. There's multiple different kinds of it, but how we use it is, without the volatility of crypto, people make investments in US dollars. We've got a multi-token architecture. So you're investing in each specific asset. We create security tokens for individual assets. We've got ID tokens, which enable compliance on our front. So full KYC, accreditation, verification, the whole 9 yards, all happens on a single platform. It's not 100 documents that people have to sign off on. We've got a governance token for each specific asset, for all the people involved in crypto, maybe thinking governance in the form of DAOs, but this is very specific to each asset. Someone has to be responsible for managing and operating that asset, and who gets to do that? That's what the governance token is. And then we have our utility token, which represents US dollars sitting in the underlying bank account for each individual investor on the Accru platform. And the movement of that is what initiates the movement of the funds. And that's what enables the entire transaction to stay on chain. And I may be geeking out too much, so feel free to stop me at any point in time.
Well,
but that's what enables the entire transaction on chain.
Yeah. Okay. So I guess, like, to address the skeptics, the blockchain skeptics, what is the security like? What is the regulation like? What sort of protections do investors have here?
Yeah. So again, we're not a crypto product. We are a traditional Reg D offering when it
Okay.
comes to commercial real estate. That is all that it is treated like. Blockchain just makes it a lot more secure because it is on a public distributed ledger. We're currently on Avalanche, originally built on Ethereum. It enables instantaneous transactions. Smart contracts are really something that make the instant transactions possible with all the if and but statements all included in it. I try to explain what smart contracts are, and usually the simplest way I would explain it is it's like a perfectly functioning vending machine. You put in a buck, and you're going to get that can of Coke at B1 and nothing else, right? If there is no can of Coke over there, you're going to get your dollar back. So that's the super simplified version of explaining what a smart contract really does. It makes sure what you're looking for is there, it exists, and you're eligible to purchase it, and you are able to buy it if you have the funds available for it. And that's what gets the transaction going right away.
Let's talk about the core product here, though, which is at the end of the day the deals on the platform, the real estate listings. So, how do you source these? What characteristics? What is the expected return? What's the return profile here? The risk profile? Who can invest? All those questions that you get repeatedly, I'm sure.
Absolutely. So we're open to accredited investors only right now, and we're diligently working with the regulators to open up the platform for retail investors. We expect that to happen in the next 12 months, and bring out offerings under the right regs for that. The deals on the platforms, we're not a fund, so we're not going to be promising returns or talking about historic returns. Individuals are investing in each asset of their choice. You're picking and choosing which asset you want to invest in. And this is what really kind of helps people and enables people to invest in today's market, where you have your capital markets, which are failing. Your stock market is down by over 16% year to date. You've got your interest rate and your inflation, which is up. Your inflation numbers are up at what, 8.5% as they came out. Interest rates are the highest in a long time. Your crypto market, which is supposed to be non-correlated assets that people were supposed to invest in, are down by 35% year to date. So this is what Accru enables. Accru enables investors to buy, sell, and trade their interest within each single independent asset of their choice. We go ahead, we perform due diligence on each asset. We're a full service solution, right? So we work with asset owners who want to sell a part of their interest within a building, and we'll conduct the due diligence on it. We'll create the offering documents. We'll list it for the initial offering, and that will provide you financials on it. So a multifamily workforce housing building or a Class C building in the Midwest would compare nothing to what a multifamily in San Fran would provide, right? So that Midwest building would provide a very high return on paper, on cash and cash, but very little growth. So people have the ability to pick and choose what they want to invest in.
Why now? Why should I or anyone consider? That's actually not a question that I've really asked anyone today yet, but I sort of meant to. Is why now? What is special about right now?
Yeah, the markets have moved. I was just talking about this. Like, we really need the ability to preserve our wealth, our retirement incomes, our funds. The way that inflation is going, the way that the markets are going, we need to be able to have the ability to invest in non-correlated assets. For me, this has been a journey of 4 years. Accru is not something that just we came up with the idea and we launched it. My background is all real estate, and so when I got introduced to the technology, we went to build for the industry, for the investors, for the developers, for the asset owners, for the family offices, for the institutions, not for hey, I'm a technology guy and I'm just going to come up with a product because it sounds cool and because this would be a great application for this specific technology. We're really using it for what makes sense the most.
That I mean that makes a lot of sense. But can you talk a little bit about the macro factors that you see sort of driving not just real estate as a whole, but I mean deal flow on your platform and interest in those deals?
Yeah, so in terms of deal flow on our platform, we've got 3 active listings. 2 of them have been fully subscribed to. Third one's active right now. In terms of macro level numbers, real estate compared to the markets that I talked about, it is up 116% year to date in terms of sales volume. The asset values have been up by over 3%, and this is just asset values. Now, when you're investing in real estate, you're not just getting that appreciation in the value of the real estate. You're also getting these distributions. You're also getting this rental income coming in month to month, and that's really what's helping build up a lot of those numbers as well, right? So compared to the capital markets, compared to the crypto market, real estate market has been performing really, really well, and it is projecting going in the same direction. So if you look at that chart, that's the last 10 years of numbers on there. So from 2012 going up, we see that dip that happened because of COVID in 2020, but you can see the line is back in the same trajectory as it was over the last 10 years. So you're looking at that upward trend. You're seeing that the demand for real estate is constantly moving up as interest rates are going up. People need places to live. People need places to work out of. Their ability to acquire is going down, and you're getting more and more larger asset owners or larger developers or larger consortiums of people, which is what we're trying to create by enabling fractional investment to go ahead and acquire these assets, and then you're getting more renters from the industry and from the market out of it.
Going back to the tokenization and the blockchain for a sec, should I expect like more, I don't know how to put this, like operational efficiencies or less red tape due to the blockchain aspect here? Because not a lot of some people that I talk to and have heard complaining about real estate has said, oh, the blockchain will fix this, like title insurance, the blockchain will fix that, right? So should I expect like on your platform specifically on Accru to see more efficiencies just because
Absolutely.
of that?
Yeah. So because we're using blockchain, we're introducing so many efficiencies. The perfect example for it is when you're looking at investing in a private placement deal, you have to sign off on subdocs and PPMs and all of those things. The asset owner then has to verify that, hey, you have certified that you're an accredited investor. If it's a Reg D offering, they have to certify that and they have to verify that. And if they don't, God forbid, if something goes wrong later, that's on the asset owner that, hey, they did not go ahead and verify this information. They just relied upon this checkbox over there.
Yep.
Using blockchain and using a structure where you have this immutable ledger to ensure that you're not only the investor's interest is protected, but the asset owners are also protected in terms of compliance is met. We're reducing all sorts of inefficiencies within the system. Even in terms of the asset management side of things, our platform enables real-time data, which becomes available to investors and owners from the asset that comes in. We've got API plugins into the larger asset management softwares or property management softwares, and we get real-time data. We don't have to wait till the end of the month to look at, oh, what's the rent roll like on this multifamily building, or oh, what's the collections like on this retail building.
Right.
And having the ability to look at that, you're really, really cutting down on a lot of those efficiencies. We do like quarterly appraisals and quarterly valuations on these, and that really makes it secure. And we peg that information on the blockchain. We secure it on the using the blockchain. So we know that the document that you're looking at is absolutely true, and no one can go back in and hamper with the document and change it at a later stage. Oh no, but so it becomes very, very difficult for people to create have any bad actors in the space, to say the least. And then most importantly, the fact that your interest gets recorded on a public blockchain, your interest is then immutable till you don't decide to sell it. That means it is 100% secure. It's not like another technology company that if the technology company for some reason decides not to pay their AWS bill or something like that, or their cloud management services bill, your ownership record is going to disappear. The immutable ledger is what brings in the trust and the trustless environment. Again, using it for the benefits, for the benefits that the technology provides, not the volatility or anything on those lines.
So how do I play ball here, Mohsin? Do I have to have a wallet of some kind or what?
Yeah, so we've made the user experience super simple, super easy. For all of those people who are well versed within crypto and within blockchain, it is a non-custodial wallet. We don't have custody of it. You have the custody of your own private keys. However, it is integrated into the platform. And you just go up on Accru.co, and it's 6 easy steps to sign up. The last step helps you create a wallet which belongs to you, which is your wallet, independent of the Accru platform. And that's where all your investments are stored. That's where your utility tokens and your funds are stored. And you have access to that regardless of the platform.
Awesome. Mohsin, anything else like people need to know about Accru, about how it works, about the availability and the terms and who it's for? I'm trying to think of those things that we didn't cover yet, because there's always things later on, like in like at like 2 o'clock today, and I'll be like, damn it, like I wish I'd asked about that. Like
absolutely. So Accru is open to credit investors, as I mentioned earlier, but we're here to democratize the space. There are, a lot of people question, how are you democratizing the space if you're only open to credit investors? There's 12.4 million credit investor households across the United States. Who isn't a credit investor? That's someone who makes more than $200,000 a year, or as a household, they make more than $300,000 a year. So, two spouses make over $300,000 a year, and for the last 2 years, and you qualify as a credit investor. So people need to a lot of people may not even know that they cross that threshold, while they really do, and we're really enabling access within that space. We're targeting those folks who are middle management across corporate America. We're targeting those folks who run their own businesses and are trying to build that wealth. You may have funds in an IRA account that you want exposure to real estate, and you don't want to invest it in something where it's going to be stuck for 5, 7, 10 years. This is not like a redemption. What our platform has is a real-time secondary marketplace where people can actually go buy and sell their shares. Price discovery is absolutely key within real estate. It doesn't matter whether you're a first-time renter, a first-time home buyer, or you're an established real estate investor, you will always negotiate on the pricing of your real estate. So Accru's secondary market enables that price discovery. You list your shares at your preferred price, and people have the ability to come and negotiate with you and go back and forth. But before they even make an offer, they need to have funds available in their account for them to make that offer. So the minute you guys agree to that price, the transaction consummates in less than 30 seconds. Our secondary market has been so successful purely because of this price discovery aspect. It's only open to credit investors. We had that major disclaimer run through prior as well, and it's not investment advice or anything on those lines. But at the same time, where we enable people to invest in assets, in individual assets directly, we let people go through go through the information on those assets, set their own risk profiles, figure out what create their own portfolio in terms of, hey, I want to invest in a hospitality asset for the high returns. I'll put in 10% of my funds in a development deal, and then I'll put in 90% in income producing deals across based on where you're going to get more capital gains and where you're not going to get enough capital gains, or we're going to have lower capital gains and higher distributions kind of deal. And people can diversify their portfolios as and when they need. And it's one-click investing. It's not like I'm going to express my interest and now I'm going to have this whole pile of documents to sign, or a whole bunch of times I have to go through DocuSign to click through all of these documents. It's like you pick, you choose, you click on invest now, and you're done. The investment's made. You see your distributions come in every quarter on the platform. It's real easy, real simple, and this is definitely the future of real estate investing, and we're excited for taking this forward. Now is the time where we're seeing true adoption come in place.
Mohsin Masud is the founder and the CEO of Accru. I'll put the link up on the screen one more time. There it is, accru.co. Mohsin, thanks for joining us today, and have a great rest of your day. Enjoy the nice long weekend. Good luck.
Thanks, Spencer. It was an absolute pleasure. You have a wonderful rest of your week. Take care.
You too. All right, let's take a markets break right now. Let's bring on Money Mitch. Wait, let me bring up my Benzinga Pro. Give me a second. And Money Mitch, how we doing out there? There's a lot of things that I wanted to cover on pre-market prep today that we did not get the chance to talk about. And I see a few of them mentioned in the chat already. But how are we looking out there, Mitch? I'm assuming we're up.
Hey, I'll say the rally continues, man. It's
Nice.
looks like all green lights out there right now, and definitely in different areas too. It's not just in technology. Technology is leading us right now, but I see strength all around. I see strength in Microsoft. I see strength in Apple. I see strength in Amazon. I see strength in Tesla today. Tesla's having an awesome day, up 6.3%. So definitely a really strong day there for Tesla. Good.
How's Ford? Oh, you know what? This really upsets me.
You wanted it?
Well, Ford. No. The upset. I just brought up Ford now. This upsets me because I literally have a document where I write down all my notes for pre-market prep every day, and sometimes I like do that, and then like the show starts, and then I like ignore the whole doc. And some days we don't get through all of it. Some days I just forget that I have more on another page. But I had Ford written down today. To discuss, not at length or anything, but I did want to mention, hey, there is a headline. Ford delivered the first electric F-150. No, this is not new news, but it's a sexy headline on a day where there's not going to be a lot of volume. It wouldn't shock me for a second if the stock pops off the open. You can choose to believe me or not, but I did think that 3 hours ago. That's what's happened here. Now, let me say this. This is an easy move to short, I think, because that kind of a move today on Ford off the open is not even a new headline. We know Ford is making electric F-150s. Of course, eventually they're going to deliver them. That's what happens when you make trucks, then you deliver them. So this is just a natural progression of the story we already knew about. I think that that green candle today is fun, but not. I definitely am not buying Ford up 2.3% here. Sorry.
Yeah, no, I think you're right. I mean, I think it's moving with all auto manufacturers, and you can see them all up today. Even like Hyzon, Ride up today, 9%. So I mean, that could give you a little bit of a warning sign that, you're seeing the dogs run. But when the dogs go barking, man, the dogs go barking. They say it, right?
All right, let's bring on my scanner. And again, we are taking a quick markets break with Money Mitch, but I'm going to return to the real estate in a few minutes here. And you say green across the board. Yeah, that's what it looks like to me as well, man.
Yeah, I didn't expect to see so much strength. I thought they would see some profit taking into kind of the weekend. So we'll pay attention to see if we see that at the end of the market day. If you start seeing some profit taking, maybe around 3 p.m. we see a turnaround. But for right now, it's pointing towards the upside.
Wait, there's a question in the chat, and I can't. I don't think it's serious, but just in case it is, I want to ask: would y'all recommend selling my home now and invest in crypto and equities, since some are now 50 to 90% off? Meanwhile, housing is at the top. All right, I'm choosing to take this question seriously, and not assume it's a joke. Please don't do that. Okay. Please don't do that, because what you need to think about is not just the potential returns. You have to think about the risk. Okay, you have to think of
Always.
always think about everything, all your assets in one pie, and you don't want to concentrate your risk too much. I definitely would not recommend ever doing that. If you have equity in your home and you want to tap it, there are ways to do that. Take a
Yes.
take a take a HELOC and a home equity line of credit, right?
Exactly.
Do a reverse mortgage. There are ways if you really want to tap into your equity, tap into your equity. It's risky, but it's way less risky than selling your equity outright. And then you got to realize the tax bill on that. And that's not a good idea.
Yeah, most people forgetting about those capital taxes.
That's not a good idea. Please don't do that. And please especially don't do it to buy crypto and stocks. I mean, we're talking about that's not a good idea.
I mean, we're still talking about the R word, right? Recession, and
Yeah,
you've seen Bitcoin go down 8 weeks in a row. Does it mean that there's an opportunity there? Yeah, it might be an opportunity. One thing that I'll tell you is that a lot of people think that they need to put like this massive amount of money into the market to make a good amount, but that's not true, right, Spencer? That's not true. Like, I don't think you need to think like, oh, I need to go back up the boat right now, or back up the truck right now because the market's down. No, the approach is to slowly tick in, especially if you're buying the overall market. I think this market has taught us, if anything, that when you're too concentrated in one area, what can happen? I think that's the important thing here. Yeah, pain. You'll go through it. I mean, a lot of people like to do stock picking also with their investment accounts. And one thing that I've learned in the long term account, is that it might not be necessary to have a lot of these stocks. It might be better to just have the overall market, because the overall market, yeah, it's down 20%, but a lot better than a lot of these other names, like let's say Amazon, or even I mean, you can look at Nvidia. I mean, a lot of these stocks are down big from their highs. So you got to be always careful. And one of the things that can keep you careful and keep that risk low is diversification. So going into a basket versus putting all your eggs in that one.
All right, let's go through the sectors here, Mitch, briefly, and then
let's run through it. Let's do it.
Yeah,
so technology here doing really well is solar. Solar is up big today, kind of getting a little lift after getting destroyed lately. But some names not bad here. Maxan up 7.23%. You can see that lift in the recent last 3 15-minute candles here. Run, Array having a good day today. ENPH, good names in solar. Computer system, Dell today made a nice little lift at the gates. Now has pulled back to the support. This one doesn't look too bad. What do you think about this report?
About the report itself, I was very surprised because I based on what we've heard from other companies, I would have expected Dell to have some serious supply chain problems. They didn't appear to have that last quarter, and they didn't appear to be I mean, they acknowledged it, but it wasn't as if they said, everyone, our business is screwed for the interim. That was very much not the case with Dell, and especially when you consider what happened last week with Target and Walmart, where they basically said no one is buying anything discretionary right now. It's all food and not for big purchases. I mean, computers are big purchases for a lot of people. And I was very surprised by that report. I really was. I didn't see that coming at all.
Yeah, let's go ahead. Let's take a look at some of the 3D printers having a good little lift today. Desktop Metals up about almost 10% now, 9.45, 47. You also got Velo 3D. This is the one that does a lot of the SpaceX, and then also NNDM. So a lot of movement on out there, and kind of some of these dogs getting a little bit of a bounce. Triple D, look at that one getting a little bit of a lift. We'll see if these can continue. Semiconductors not doing bad either. I saw Nvidia up a pretty decent amount, so you can't go wrong with that. Nvidia's up about 3.5. TSM about 2.4. And how's our AMD, the darling, right? Darling's up right now, but we'll see if these can continue. We'll see if we get a turnaround. Real estate has been really pushing back here. I think a lot of this was Toll Brothers. So you can see Toll reported earnings. I believe it was on Wednesday. Yeah, I believe it was on Wednesday.
One of those days. I don't know. The days all blend together for me.
From then, you have seen Toll Brothers have a nice little run there. And you can take a look at some of the other real estate. Consumer cyclical has been really improving. I'll show you guys here on the daily. Look how this has really just came off the bottom. There is somewhat resistance up here, so we're going to see if we find some resistance in, like, let's say, auto manufacturers. But gambling even coming back. DKNG finding a little bit of a bid. When you think about it, I remember when I put in our Benzinga trade ideas widget. You guys haven't checked that out, go ahead and check it out. But I put let's start dipping, and that was right here when it was coming down through 13. I said let's start dipping and maybe averaging through 13s down to $10 and potentially leaving a little runner like to buy like closer towards 9. And it was a good look there. DKNG has come up about from that 11 about 46%. So it has been a big run up there. Now the question is, does this get turned around? That's the thing we'll be watching. In summer, there isn't too crazy kind of sports betting numbers, right? About to get into the NBA finals, about to get into the Stanley Cup finals. But after that, you get a little bit of a die down time, right?
Yeah.
So
yeah,
just be careful.
Yeah, that's true.
We'll
It
see
is
what
summer.
happens.
All right, Money Mitch Hodge, thank you for stepping in and providing us with a little bit of color on the markets today, because we never want to stray too far away from our core competency, which is the stocks. Don't forget, markets closed on Mondays, obviously. So, Mitch, good luck with the rest of your day, man. Stay green, all right?
Pump that gas, man, because it's getting expensive.
I just filled up last night. I literally did a double take, and I expected it, but I did a double take. I drive a puny Ford. What do I drive? A Ford Fusion, and it was like $67, $65, and I was like, "What?" Anyway, all right.
Later, man. Have a great one. We'll see you guys.
That's what I get for not going to Costco to fill up. All right. But real fast, before I bring on our last and final guest of the day, I just wanted to do a bit of a shameless plug. A lot of the information that we're discussing on this show today is available in written form. So I'm going to drop a few links into the chat right now. This one is sort of a general Benzinga guide to real estate investing as a whole. Let me drop it in the chat. There's one chat, and
battery 30%.
Right there. And then the second link is specific to real estate crowdfunding platforms. I realized that there's a lot of information being conveyed on this stream, and if you have not been taking notes or can't retain it all, it's fine, because we've written guides for you. So I'm dropping the other link in now. Both of them are now in the chat. If you are at all interested in real estate, which frankly you should be, as we've discussed today, there are macro reasons why you should consider real estate right now. And you're interested in real estate crowdfunding in any one of these platforms, use those links that I just dropped in the chat for you. They should answer most of your questions, or at the very least, just get the ball rolling for you. And then obviously the onus is on you to do more research there. Okay, let's move this along and bring on our final guest of the day. I see him here backstage, Drew Sterrett. He is the co-founder and the co-CEO of LEX Markets. Drew, how are we doing today?
Living the dream. Happy Friday.
Living the
Going
dream.
Into a long weekend.
Happy Friday to you. It is a long weekend. That does mean that some people like to stop working, start the weekend early, but we're here at Benzinga still grinding. Tell us quickly about LEX Markets and what you do.
Absolutely. So we created the first commercial real estate securities market. You can sort of affiliate it with a stock exchange. We allow individuals to buy, sell, and trade individual commercial real estate assets across the United States directly from their brokerage accounts.
That is not like any of the companies that we've heard from today already. How did you do that? What and why?
So the why is actually very selfish. I was working at a real estate private equity firm, wanted direct access to commercial real estate. REITs are highly correlated with the public markets and are not actually truly representative of real estate as a holding.
Interesting.
So we could go down a long rabbit hole there.
Okay.
And so
Okay.
it was
You
personal
you said
desire.
it. You said it, not me.
Absolutely.
Okay.
Absolutely.
Okay.
So I'm
Okay.
willing to own that one.
Okay.
But it was personal desire, and it was it really came down to the question of how do we have the oldest and largest asset class in the world and one of the largest wealth creators in no public and liquid markets. It's only for the 0.01% for having direct access. And I thought that was a little messed up and needed to be fixed. And a few years later, here we are.
All right. Before we get into some of those hot takes there, how exactly does this work? So I have a brokerage account at Brokerage X. I don't know if you can get specific there, but I have an account at Brokerage
Yep.
X. I can buy and sell real estate through Lex on that brokerage.
Correct. So you can look up, here's a ticker, look up TESLU.
I don't have
Tesla.
anything. I don't have anything open right now.
Okay.
You're throwing me under the bus. Sorry.
Sorry. No. And so we do IPOs where we're taking the assets public, and then on the secondary market, you can buy, sell, and trade at any point in time. So each one is QSIPed, registered with the DTCC, settle CNS, so literally can be held in any account, anywhere.
That's essentially what this says, right? And maybe it's a
Yep.
better summary. IPOs for individual buildings. What sort of I don't even know how. There's so many questions here. Like, how are these different? I know they're different from REITs, obviously, but like, how are they different from REITs in terms of the securitization?
So we actually structure it so you get the end investor, right, gets all of the benefits of owning real estate. So all of the tax benefits, pass through, depreciation, qualified income deductions, increase in business expense caps. The long-standing joke that I've always said is, right, Donald Trump only paid $750 in federal taxes. There's a reason for that. Not only sometimes because of interesting accounting, but because real estate does allow for a lot of tax benefits to flow through to the end investor. So you can also offset other passive income, claim losses, and then continue to take in passive income at the same time. Also, I cannot give tax advice. I am not an accountant and a CPA, but everyone can look into that themselves and make their own conclusions. But it is structured as a PTP, a publicly traded partnership.
Okay. I'm not familiar with the PTP term, and I'm struggling to like bridge the gap there. I've got half my brain on like the exchanges and the other half my brain on like commercial real estate, and you've bridged that gap, and I'm struggling to do that myself. So let me just bring this table up that I hope answers some questions here. But how is this possible? Is I guess my question.
Well, we created an alternative trading system, an ATS, which is one level below a national stock exchange. We created a retail brokerage platform ourselves. We're also a licensed investment bank and broker dealer. We built a lot, and also built a brand new security structure to bring this brand new asset class to the market, something that should have been done 50 or 60 years ago. And a lot of hard work from the team. That's what it comes down to.
All right, how many IPOs do we have? What's the pipeline there, and where are these IPOs?
So the IPOs are everywhere. So the first asset we ever took public was actually up in Portland, Maine. The second one was here in New York City. We have a third one open right now in Seattle, which is brand new multifamily. It's basically ESG on steroids. It's passive housing, so effectively carbon neutral. So we're creating more carbon offset right now on this call than that building does in a year, and it's 100% occupied. And also, if anyone wants to check it out, we have a special code for Benzinga today, where if you use the code ACCESS and you deposit $5,000 or more and create a new account, you get $250 plus into your new account as well. So if anyone wants to check out that IPO.
Code access, ACCESS. Yeah, here's a good question that I'm sort of wondering myself from Abel Matthew in the chat. He's just asking about the logistics of all this. So each property has like X number of shares in the float, or is the building divvied up by the float? How does that work?
So basically, when we do an IPO, we say, okay, we're going to take 49% of this building public.
Okay.
And so we take total asset value multiply it by 49%, and then we price each IPO around $250 a share. So let's say we're doing a $10 million IPO or a $100 million IPO. You take $100 million and then divide it by $250, which would be the IPO price. And then at that point in time, you get the total number of shares in that float forever.
Pretty self-explanatory. And then I'm imagining one of the biggest advantages of this is because it's these trade just like stocks would trade. It takes rid of the liquidity concerns that exist in real estate. It gets rid of lockups. It gets rid of all of like the friction that typically comes with investing in any non-REIT real estate asset. Did I get that right?
And also, it's the same, and it's even as easy as buying a REIT, right? You place a market or limit order, click submit, it fills, and it's in your account.
That would make sense. And I would be remiss not to mention, but you guys IPO'd a new property yesterday?
Yeah, so that's Solus. That's a
What's
Seattle asset.
What's the ticker on that?
So that one's still an IPO right now. So it's still
Okay.
IPOing, so people can still access the IPO. And that's the multifamily Seattle asset.
Interesting. So then walk us through that process. So it's still going through the IPO, and once it's fully funded, then it will begin trading. Is that how that works?
So there's actually a min and a max. So
Okay.
our whole belief is actually democratizing real estate, the access therein. So we also let the everyday investor sort of come in, where in traditional IPOs, right, getting IPO allocation is usually difficult and you're competing against the institutions. So we actually let the little guys go first, then fill, and then exactly. So changing the game.
You flip the Uno reverse card on them, go backwards.
Exactly. Yep.
Nice. I am wondering though about the tax implications here, because you talked about that briefly, but the tax implications of owning a REIT or anything on the secondary market is relatively straightforward. But because this is the different type of security, what do I need to know about my tax exposure here, or tax implications for me, good and bad, before I go and buy one of these tickers?
So on our website, we give a rundown of how the structuring does work from a tax implication standpoint. Actually, a lot of public stocks do, especially oil and gas. Basically, any oil and gas company is structured as an MLP, Master Limited Partnership, which is the cousin from a securities standpoint of a PTP, a publicly traded partnership. KKR used to be a publicly traded partnership. A lot of actually big companies used to be publicly traded partnerships up until, I would say, in the last 5 or 10 years. But oil and gas is still basically the cousin of this structure.
So you would get like a K1 or something?
You get a K1 at the end of the year, on time. No delayed filings.
That's pretty important there. I'm going to drop the URL up on the screen there, lex-markets.com. Okay, I have a charting platform open now. You want to give me a ticker and I'll pull something up?
Yeah, Teslu, TESLU.
Got it. All right, this is a relatively new one. Let's go to here, I'll zoom in here. And yeah, that only IPO'd when? A month or two ago?
A month ago? Yeah.
All right. What can you talk us through this? What is this?
So this is actually an asset here in New York City. Wells Fargo anchor tenanted, medical nursing office above, long-term leases, fixed interest rate debt for, I think, roughly another 10 years, locked in at something like, don't hold me to this, but 2.45%. So especially with interest rates going up right now and inflation, I mean, you sort of have a 5-point delta, or 500 basis points delta in between sort of where money is actually tracking and the free money that they effectively captured.
What should I expect from, in terms of the characteristics of this security, in terms of the beta, in terms of the volatility? What
The
can I expect?
volatility. So, right, these are hard assets where the markets aren't moving, and in this case, it's a fixed rate debt on top of the asset, and it's long-term, very good credit tenants. So you should just expect quarterly distributions for the most part. There's also heavy amortization, so 5% of the debt is being paid down every single year, and so you would expect a trend line of sort of up and to the right, slow and steady growth, not a lot of volatility since right? You have long-term leases and long-term debt. So you would expect that you don't have a whole bunch of volatility. I think they just posted the new NAV last week where the price target or the NAV of the asset is now at $258 a share.
I want to go back to that comment you made earlier about REITs. We think of REITs as diversifying instruments. What do you have against them?
So a few things. One, tracks directly with the market. We could pull up the Vanguard REIT like index and compare it to SPY. Actually, it's
Oh,
a fun thing to do, and then you'll
dude,
see like
let's
the
do
heavy
that.
core.
Let's do that
Yeah,
right now. Yeah.
yeah. Let's look right there.
Okay, wait a minute. So yellow is the S&P 500. The teal, the light blue, that's the Vanguard REIT index,
Yeah, so it's actually
and the
done worse than
dark
the
blue,
market.
the dark blue is you.
Yep, doesn't
Why
look too
why
correlated to me.
why is this? I'm trying to
So
understand.
REITs have been heavily tied to the market for a long time now, and increasingly so also with increasing interest rates. REITs have to take on new debt to go acquire new assets, so they always have to grow for the most part, right? So whenever you're doing a new acquisition, they have to go get more financing. So when you're in a very low interest rate environment, that's much easier for them. It becomes less and less attractive for them to go acquire new assets if interest rates are increasing. And so it's very heavily tied to where our interest rates trading at any given day.
I gotta say this
Eh,
chart is surprising to me. Wait a minute, Drew, you're on mute. I just lost you there.
Can you hear me?
Yes, now I can.
Perfect.
Okay, great. Yeah, I was just saying this chart really just surprises me. I had never seen that correlation before. I always just kind of assumed, honestly, maybe that's my problem, is I assumed incorrectly that REITs, real estate, it moves differently with equities, but it is an equity instrument, so I guess it would make some
Mhm.
sense as to why that does that. So let's talk about your deal flow, for the deal flow on Lex. Where do you find these properties? How do you vet them? What's your due diligence? All that sort of thing.
I'll make you laugh. We actually took AIG's underwriting and due diligence process and upped it by 10x. So basically, imagine going to a private equity firm or an investment bank and their underwriting process. That's the process we do. We actually throw out 95% of the deals that come in the door. And we have people coming to us from all over the place. We have a dedicated team. We go through commitments committees with third parties. We also get third party reports on the asset, from appraisals to property conditional reports, engineering reports, um, everything under the sun. And so we do full underwriting and due diligence. And from our standpoint, even though we don't act in this capacity, we don't do a deal where we wouldn't also put our own money into it from a personal standpoint, where we didn't feel comfortable with it.
But you're not doing. But I'm imagining there's some conflicts
So,
there, right? That you probably
so basically, what we're saying is, while we are a fiduciary in an underwriting capacity,
right.
we do not take on a deal that we don't feel comfortable putting our own money like where our mouths are.
Okay. Um, and just to be clear, these securities, which is I guess what they have to be called, are these properties. They trade OTC, so not on any exchange. And someone in the chat noting how there's no ask right now, so the liquidity may be a little bit wonkier than some are used to. Is that fair to say? Just
Well,
because it's
so right now, what you're seeing is the bids and the asks on the OTC for these securities. So we also created our own trading venue, the LEX ATS, alternative
okay.
trading system. So we have our own dedicated customer
Okay.
base and also liquidity on that platform as well.
And what does that look like right now, out of curiosity?
So we actually have an open order book. So there is full depth. Yeah. You get to see it's not just best bid and ask. You get to actually see the entire depth of book at any given point in time.
All right. All right. Did not expect that answer. All right. So we here, I want to bring up this slide because this actually sort of gets at the little bit, the complex market structure of all this. And this is a little bit of a dense slide there. I'm just going to ask you to just kind of explain without getting too into the weeds here. And if you can just explain what all this says.
It says we built a whole bunch and we connect directly into the financial infrastructure at large, which is how you're able to pull it up from your brokerage account. But then we also connect really into the entire financial market where, let's say you wanted to purchase this overseas, not from LEX directly. You wanted to go to your TD Ameritrade, Interactive Brokers, Fidelity, Schwab, Wells, you name it. You have access to these securities everywhere at any point in time, and it's really an open infrastructure. That's really the takeaway. This is meant for everyone to access.
So because people are buying and selling these on the public markets, on secondary market, what is the fee structure? There's no fees here.
Yeah, we don't take trading fees. We want to promote as much liquidity as possible. So
dare I ask, how do you make money?
Yeah, great question. You can dare to ask.
Okay.
Also, big Warren Buffett fan, companies should actually make money.
Yeah.
Yeah, no, I know. It's sort of interesting, right? The markets have actually sort of touched on that
They have.
in these past weeks. So it's a no fee load to the investors. So back in the olden days, there used to be a 10% fee load, like any private REITs that were being sold, where let's say someone was investing $100,000, they were only buying $90,000 worth of equity of the product, which doesn't really seem fair to the investors. So as we continue to do, we sort of flip the coin on its head. So we actually make the real estate owner pay the upfront fee of going public. That is not a fee load to the investors because they're getting liquidity and access to public capital markets, and we hold their hand through that entire process. So the real estate owner pays, and then on a go-forward basis, we take 25 basis points per quarter out of the cash flowing distributions to pay for the equity servicer, the issuer counsel, the third-party financial audits in the year, everything that goes into running a public company.
Got it.
We joke that it's SaaS, but it's securities as a service instead of software as a service. Yeah.
Okay, that would make sense. These are cash flow producing instruments, so it would make sense that that's now that I think about it, that's where the money would come from on the back end. So all right, I mean that all checks out to me. Is there anything that people need to know about before they go and buy one of these assets? Because again, as I said earlier in the show, every company that we've had on today plays in the same sandbox, but they all have different wrinkles, and this is definitely a different wrinkle. So what do people need to know before they go and buy like the TESLU, for example?
So I would say read the information, right? We actually provide more information than you would ever want, which is a pro and a con, right?
Yeah.
So I would say read the details, right? You want to know what you're owning, and it's good to understand the fundamentals of the assets themselves, how they're performing, what their outlook looks like. Actually, sort of from your last segment when you were talking about selling your house to buy into stocks.
Yeah.
And my biggest takeaway there is diversification is the only free lunch in life. And then also you have to be able to stand a drawdown at any point in time, right?
That's it.
And if you sell your house, you then don't have a house, I would be concerned. But I would just say everyone should keep that in the back of their head, being like, these are the markets. They do go up and they do go down. We have been in a bull market until recently.
Yep.
So it's easy to be a genius in a bull market. In a bear market, yeah.
I was a massive genius in 2020. I don't know about you, but I was like the world's best stock picker. And then something happened when the calendar turned. I'm not quite sure. I haven't quite figured that out yet. Drew Sterrett is the co-founder and the co-CEO of LEX Markets. Drew, a pleasure to talk today. Thank you so much for coming on, explaining LEX to us, and good luck here going forward.
Thank you, Spencer. I really appreciate it, and happy Friday.
Happy Friday. And there's the link up on the screen again, lex-markets.com. All right, guys, it is 11:15. We have arrived at the end of our latest All Access show. As a reminder, this show is sponsored in two ways. The first way is that all the companies that appeared on today's show have paid Benzinga. This show is one of the ways that Benzinga monetizes its YouTube channel. However, you can email them and ask them. They would corroborate the fact that none of them knew going in what we were going to talk about, because I didn't know what I was going to talk about until it came out of my own mouth. So hope you appreciated that. Second thing is, the sponsor of our All Access series is Ticker. They're the premier sponsor of the show. They sponsor every single show that we do here on All Access. What is Ticker, you ask? Oh, great question. I'm glad you asked.
What is Ticker? That's right, Ticker with two eyes, just like you. Because it's for you, for investing, for stock perks, for connecting you to public companies who reward you as a shareholder, as a brand lover. That's why people can't stop tickering. Discover shareholder perks, and consumers become investors in the brands they love. Ticker. Start tickering today.
All right, use the link up on the screen, tiicker.com/Benzinga, and that will send you to an offer page. All you have to do is create an account on Ticker, connect your brokerage to that account, and if you keep that account open for 30 days, Ticker will send you a $20 Amazon gift card just for creating an account. It's that simple. Hey, how are we doing on likes? It says smash the like up there on the screen. What's the like situation today? Like situation is 90. Oh my gosh. We can't even get to 100? We can get to 100. I'm sure we can. I have faith in us to get to 100 likes. Here, I just liked it now. Now we're at 91. I just liked it. I didn't like it before. All right. So here's the plan for the rest of the day. All right. Benzinga Live is happening. I expect to go live with Aaron Bree in around 10 or so minutes. We are going to do an abbreviated show, though. We're going to end Benzinga Live at 1 o'clock. Moon or Bust will go live at 1, and I expect to be doing At the Close with Joel Elconin at 3:30. But today's the kind of a weird, like, pseudo half day at Benzinga, but the markets are open, so we're still here, so kind of weird. But anyway, we will be doing Benzinga Live in around 10 or so minutes, so I hope the video redirect is set to redirect you to that stream. If it's not, I will be angry. But that's what I got, everyone. Again, we didn't do this show today just by accident. This was very intentional. We have been getting a lot of questions about alternative assets, about real estate, about what to do with my money, because I can't own stocks, I can't own bonds, I can't hold crypto, and I can't own cash, or I don't want to do any of those things. This is a alternative. Okay, there are platforms out there that are having their moment, frankly, because real estate's having a bit of a moment right now. And even though I know prices have come off a little bit, it's a great diversifier. And I'll be honest with you guys. I know there's some tension out there, right? There's some tension because a lot of people are priced out of the real estate market, and I'm in that group with you. I seriously am. I'm priced out right now. It's not fun to not be a homeowner, but think about it like this: you can still get exposure to real estate without owning a home. That's the point here, right? You don't have to own a home to own real estate. You can own a REIT. You can do any one of the platforms we had on today's show. LEX Markets, CalTier, Accru, CityVest, Crowdstreet. And there's your hedge. There's your exposure right there. There's your hedge against your own inability to buy a house in the future. At least you can still participate. That is the point. Okay. I'm done. That's a wrap. I'm going to take a 10-minute break and head on over to Benzinga Live. I hope that stream is set up, producer Aaron, because if it's not, well, then I'll be angry. But I see it is, so we should be good to go. All right, everyone, drop me a like if you can. I'd appreciate that. And thank you for watching Benzinga All Access. Tiny Fight. I'll see you in 10 minutes, man, on the next show. Come on.